Hey everyone, recording a quick video for you on how to use seasonality in your trading. So this is one of our evening research notes, and on each of our weekend research notes, I always include our seasonality heat map. So let's scroll down to it. This is actually something that I created back when I worked at YCharts. I used their Excel add-in to create it, and this is now a template in their template library. So anyone that is a YCharts user can access this. There's also seasonality templates that I believe are on TradingView. Some people have written some scripts for those, and you can always leverage our weekend research notes as well. So to dive in here, what are we seeing on this heat map? Well, we have about 25 years of S&P 500 performance data, and these are 1 month total returns. Then we have a summary table down at the bottom, which is showing us for every performance month, what was the mean return, what was the maximum return, so the best month ever for this time series, what was the minimum return, and then what was the win rate. Out of these 25 years, what percentage of those years had a positive performance? Now that that's out of the way and we know what's going on, then you can see these are the yearly returns for each year right on this right side. Now, I've been highlighting this for the past 2 weeks, really since about August 15th, that the seasonality into September is very poor. Now, with seasonality, it's not a silver bullet. As you can see, for September, there's a 52% win rate, meaning that on more than half the months, the S&P 500 was actually positive. And you can see in 2024, we had a positive 2.1% return. Now, the reason why it still makes sense to potentially be a little bit more cautious heading into September is because on the months that were negative, you can see there were some very large negative performances. So in, I believe 2022, there was a negative 9.2% return. In 2011, negative 6.9. In 08, negative 9.4. The list goes on and on. The worst one was in the year 2002 with a negative 10.5% return. So with seasonality, this isn't some sort of silver bullet where it's like, okay, September's coming up, now I'm just going to go nuclear short on everything. Trading doesn't work that way, and if you approach this that way, what's going to happen is you go nuclear short on everything, and then a year like 2024 happens. Market goes up 2.1%, and suddenly you're blown out. So the way that I use the seasonality is if the market starts to get a bit more technically weak in the latter portion of August, then that could be a signal to be cutting risk into September because the market is getting weaker. So it always makes sense to take this, know that, hey, I'm going to set my expectations a little bit lower for September because the market could be a little bit weaker. And then maybe if you get some confirmation that the market is weak, like we are getting today, where the S&P 500 is down considerably. Let's just take a quick look at these charts. Yeah, you can see market's down below the 20-day simple moving average for the S&P 500. The NASDAQ is undercutting the 50-day SMA right now. All these indices are very weak. For me, as someone that knows about this seasonality data, I might see the market coming off the lows, but I'm not going to necessarily jump in and take a bunch of risk because we still have arguably like 20 days left in this trading month. So if you do that and you jump the gun and you go, oh man, the market's off the lows, I'm going to dive into stuff, then for all we know, over the next 5, 6, 7 trading sessions, the market dribbles lower and then you can be in big trouble. So the seasonality is best used as a way to maybe develop a bias on the market, maybe develop some sort of expectations. But at the end of the day, what's very important is just always understanding, just because the seasonality is weak, that doesn't mean the market has to be weak. And then it also helps where, for example, for this go round, it's not like I went and sold out a bunch of positions, right? I wasn't like preemptively, oh, September seasonality is weak, let me close out all my big trades. But for me, now that the market is pulling back, mentally it's so much easier to deal with that because I had a low expectation coming into this month. So my approach, actually, given that I'm way above water on all of the trades I'm currently in, is just accept the drawdown if it happens in September. If the market gets super weak, everyone starts puking up their positions, I will inevitably take a drawdown on my positions as well, but that is okay because I'm doing pretty well on my open trades. So with that said, that about does it for how to approach seasonality, how you might use it in your trading. Hope this has been helpful.